Let's today look at an example of how borrowing money from a bank compares to borrowing money from an insurance company. I am Russ Morgan. I look forward to going through this example with you today. Over the next 10 minutes, I'm going to try to simply show you the differences between saving and borrowing money from banks versus an insurance company. I'm going to show you an example of buying a car and how you can use a traditional bank. You can use the process that was written in the book Becoming Your Own Banker to pay yourself back, and how that adds more cash to your ultimate net worth in the end. I'm also going to show you how you use it with an insurance policy. I'm going to use an insurance policy that was created on myself. It may or may not have the same results for you, but it will at least give you an example of the two and why one or the other might have more or less money in them. So first, let's talk about saving money in a bank, a traditional banking savings vehicle, and I'm going to assume that we're going to save $10,000 a year. I'm going to assume the bank interest rate on this account would be 3%. This is obviously a hypothetical interest rate, but in the time frame that we may be looking at, interest rates may be higher or lower than this. This should just give us a working knowledge. I'm going to assume a 25% tax bracket because traditional savings accounts, money market accounts, and CDs will have taxation on any interest that is earned in those. And I'll net those out as you see right here and put those in the account value at the far right. So if I look at saving $10,000 a year for 30 years, paying the taxes, earning 3%, the account at the end of 30 years would have $431,447. Well, now let's look at borrowing money. We all buy cars in some shape or form. The most traditional method is to borrow money for the car. We would borrow from the bank typically that we're saving money in. So we go down to the bank, we tell them we want to take a loan for $20,000. The interest rate is 6%. They tell us the monthly payment for that is $395 a month. And we continue on down the road. We're still saving money over here, but we're paying $395 a month for 5 years for our $20,000 car. Well, obviously at the end of our 30-year period of time, we would still have $431,000 in our savings account. Yet we were lost. We had less $395 in our cash flow. What could we have done? Well, we could have paid cash and kept the $395 a month. So I want to show that example. How is it that we pay cash? We avoid the interest cost to the bank. We take the same $20,000 out. We have no payment. And in 30 years, our account value has $394,000. Now, why is it that it had so much less? Well, the concept of our money has a cost, whether we pay cash or we borrow it, has to resonate when you see the numbers. You realize that we lost the 3% earnings on the money even though we didn't have to pay interest to the bank. Now, some of you have recognized the fact that, yeah, but I still had $395 a month. I could have saved that. And so I want to look at that example of saving the $395. But I do want to challenge you, how many people you know, not you, of course, but how many people you know would save the $395? Would it be a lot or would it be a little? Where would the $395 most likely end up? Probably at Starbucks, McDonald's, other vacation items, less likely back in their account, right? But that's not you. You would save the money. You would take the same $395 that you would have had to pay and you would have paid it back to yourself. That's recognizing that your money has a cost. So you would have taken the $20,000 out of your savings vehicle. You would set up a payment for $395 back to yourself, and at the end of the 30 years, you now would have had that money accumulate back for you plus some because of the interest you would have earned on that money. So you would have ended up with $435,000. Sounds great. Is there anything better? Well, one of the things I would challenge you on is the fact that the $20,000, when we took it out, it no longer was earning interest. Only the $47.48 we paid back, the $395 a month, each and every year was going back in that account. So there was interest that we could have been earning on the $20,000. How much did it truly cost us? The second thing we need to look at is this column of taxes. Because whenever we are accumulating money in a growing taxable environment, we're obviously giving money away that could have been earning interest for us as well. But how big of a difference is that? Why is using a specially designed whole life policy that is created in a form where the growth on the policy is not subject to taxation and loans against the insurance policy from the insurance company is not subject to taxation? How would that differ? Well, here's an example of a policy on myself purchased 5 years ago. Again, the results may be better or worse for your scenario based upon the time frame in which you're doing your health rating. But if I use the insurance policy that I purchased on myself, I bought the same $20,000 car, except I set up a loan from the insurance company in which I'm going to pay 5% to them. I'm going to pay back 6% total, just like to keep the same $395 a month payment that we had in the previous examples. But the insurance company is going to take 5%. That money is going to them, it's not going to me. How might my account grow over the same 30-year period of time? Well, if we notice that we still have to take off the taxes because the insurance policy is not accumulating taxes on the cash value, and I scroll down to the end of 30 years, you notice that I have $701,000 in my account. If you'd like to know how this worked, I encourage you to take time to read more on our blog as well as to contact us, and we'd be happy to show you an example of how this might work for you.